Telkom says it's made good progress in the 2024 financial year, despite inflationary pressures and the added operating cost from power outages. The firm's posted a 1.6% rise in revenue to just over 43 billion rand. Headline earnings per share, meanwhile, improved to 376 cents. Telkom cited continued demand for its next-generation offerings, as well as cost optimization initiatives. Looking ahead, Telkom says it's confident that it will be in a position to pay dividends in the near term and is targeting its 2025 financial year end for that move. Exceptionally strong, that's how Stor-Age has described its performance in South Africa over the past year. The REIT says the UK presented a more challenging environment compared to the last few years, but it believes that the business is well positioned in both markets. Those comments accompanied its year-end performance. Rental income for the period came in nearly 15% higher, supported by the strong showing in SA. Stor-Age has reduced its dividend by just over 2% to 56.8 cents. Sanlam's buying a 60% stake in MultiChoice's insurance business for 1.2 billion rand in cash. The deal's terms include a potential performance-based earnout of up to 1.5 billion rand. The pay TV operator says while that business has demonstrated substantial growth in South Africa, its expansion ambitions require a step up in resources, expertise and technology. And that Sanlam's presence and expertise across the continent, coupled with its track record of success in insurance ventures with non-insurers, positions it strongly for a strategic venture. Sanlam, meanwhile, has added that this deal will allow it to advance its strategy of using technology to expand access to financial services across Africa. Thungela Resources has flagged lower half-year profit. It's pointed to a decrease in the benchmark coal prices, a drawdown on stockpiles from December 2023, and an increase in lower quality coal in the export sales mix. As such, headline earnings per share for the period are expected to register a drop of between 55 and 69%. Thungela has added that the underlying operating environment remains uncertain. It says macroeconomic and geopolitical headwinds persist, alongside continued rail performance challenges in South Africa. Transnet wants to procure renewable energy and desalination plants. The state-owned company says the move targets ports at Nelson Mandela Bay in the Eastern Cape and forms a part of plans to invest in a climate-resilient infrastructure and to reduce its energy costs. It's issued 3 requests for proposals for 2 solar-powered seawater desalination plants and a renewable energy power system. On the international front, Tesla has begun the legal battle to get approval for Elon Musk's $56 billion pay deal. Shareholders last week approved the package, a record sum in U.S. corporate history. Here's more detail in this package report.
Delaware Judge Kathleen McCormick ruled that the process leading up to the package had been controlled by Musk. She said Tesla also concealed from shareholders key details about the targets he had been required to hit. Now the EV maker says it has fixed those problems. Besides the vote, the pay deal was reviewed by a special committee of the board, and the firm has provided hundreds of pages of added information. Though the sum seems enormous, Wealthwise financial boss Noreen Gilbert says Musk should have been paid.
The pay package had actually been agreed upon years prior based on metrics that Elon Musk had to make good on. And he had made good on all of those metrics. So the fact is he should have been paid that amount. He jumped through all the hoops to make that happen.
Tesla has now written to Judge McCormick asking that parties to the legal dispute over the pay now set out their takes on the shareholder approval. One shareholder who brought the case against the package has already said he thinks the vote has no legal effect.
And Ukraine continues negotiations with bondholders and other investors after failing to reach an agreement on restructuring $20 billion in international debt, raising concerns about a potential default and deadline. Here's our reporter Anatin Devo with more.
That's right, Zinati. More than 2 years after the full-scale Russian invasion of Ukraine, A default deadline now looms for Kyiv. And for more on these talks, specifically on how Ukraine wants to restructure $20 billion worth of international debt, we're joined by DW's Cassandra Sant, who is currently standing by in Berlin. Cassandra, thank you so much for your time. Tell us, what about the debt talks that happened yesterday between the Ukrainian government and the group of investors?
Thanks for having me. Well, that's right. These talks yesterday were about how Ukraine can restructure about $20 billion worth of international debt ahead of an August deadline. Now, the agreement that's currently in force between the Ukrainian government and the international bondholders essentially allows Ukraine to suspend payments. That's because of the full-scale Russian invasion of Ukraine. But the clock is ticking as this deal is set to expire later this summer. Now, Ukraine's finance minister has said that the country's economy was in a, quote, fragile balance, and that it hinged on consistent and substantial support from its partners, adding that the timely debt restructuring is a critical part of this support, and that, quote, strong armies must be underpinned by strong economies to win wars.
Cassandra, what are the proposals that are on the table?
Well, these two sides are very far apart at the moment. Ukraine has offered to swap bondholders' existing debt for 5 sovereign bonds that would mature between 2034 and 2040. Then there would also be a so-called state contingent debt instrument, or SCDI, and that would be linked to tax revenues. So Ukraine has offered investors an option of including only conventional bonds, but overall the offer would have translated into a debt haircut of between 25 and 60%, and that depends on the performance of those SCDIs. Meanwhile, the bondholders on the other side of the negotiating table here, they put forward 2 counter proposals, both of which carried a nominal haircut of 20% and allowed for the potential full recovery of concessions. The packages also consisted of 2 types of instruments, including paying a coupon in excess of 7%, as well as a, quote, recovery bond that featured variable step-up payments. Now, all this is according to a Ukrainian government statement. Kyiv added that neither of the bondholder proposals meet International Monetary Fund requirements.
And how realistic is this debt restructure idea? We know that Kyiv is still actively fighting Russia after all.
Yeah, analysts have said that undertaking a debt restructuring like this while in the middle of a raging conflict is a huge undertaking. So this was seen from the jump as an unprecedented and monumental task for Ukraine. Meanwhile, Kyiv's bilateral allies, think of countries, for example, like Germany and the U.S. who are supplying aid, they're plowing billions into the country to shore up its war effort and economy. And countries like this that are supplying money, they generally don't want to see that go back into, they want to see that going towards buying aid, not paying back debt. But with all that being said, the IMF is set to release its next review of Ukraine's financial state within the next few weeks. That would include key figures about how much debt relief it thinks the country needs.
Well, let's leave it there for now. Cassandra, thank you so much for those insights. That was DW's Cassandra Sant.